It's crazy to think about some of these huge private equity deals that just completely change entire industries.
Yeah.
Like imagine a company that looks totally stable on the outside,
Mm-hmm.
and then suddenly this private equity firm swoops in and buys the whole thing,
Right.
but they don't actually pay for it all in cash. They
Yeah.
use a ton of borrowed money.
Oh, yeah. Leveraged buyouts.
Exactly, LBOs.
Tons of risk.
So much risk. And it's especially wild when you consider that the whole deal is based on the US dollar, which can be so unpredictable.
Yeah, it really makes you wonder what makes those firms take that kind of gamble.
Totally. And that's what we're diving into today.
Okay, I'm ready.
We're going to try to figure out why a weak US dollar, which sounds like a bad thing,
Right.
can actually be a huge advantage for these private equity firms.
It's a fascinating dynamic for sure.
You've been really interested in the whole world of how these complex deals come together
I am, yeah.
and how private equity firms find these hidden gems.
Absolutely. The art of spotting potential that others miss.
Exactly. And the US dollar plays this often overlooked role in all of it.
It's like a hidden current that can shift the whole tide.
Perfect analogy. So today we're breaking it all down for you.
Awesome.
We're going to show you how a weaker dollar can actually make things easier for private equity,
All right.
from finding those bargain businesses to getting the money for those massive leveraged buyouts, all the way to figuring out how to sell everything for a big profit at the end.
That whole life cycle of the deal.
Right. We're looking for those aha moments that give you a new understanding of how the financial world really works.
Love it. Let's jump in.
Okay, let's start with the beginning. How does a weak dollar make certain businesses look more appealing to private equity firms?
All right, so think about it from the perspective of an investor outside the U.S. Let's say you're in Europe and you have a bunch of euros.
Okay, got it.
Now, if the dollar gets weaker compared to the euro,
Meaning the euro is stronger.
right, suddenly those euros can buy you a lot more dollars than they could before.
Makes sense.
So for a European private equity firm looking to buy an American company, it's like everything in the U.S. just got put on sale.
Like a built-in discount.
Exactly. And that can be a huge incentive to start looking for potential deals.
Especially for private equity firms, their whole game is finding undervalued assets, buying things for less than they're really worth.
Right. And a weak dollar just amplifies that whole concept.
So a European firm sees a U.S. company doing well with solid growth, but the price tag in dollars might not seem that impressive. But when they convert those dollars back to their strong euros,
Boom. Suddenly it's a bargain.
it's like they're getting a bonus just because of how the currencies are moving.
And that can make a huge difference in their decision to buy or not.
This is exactly the kind of insight you are interested in, those little quirks of the system that can give someone a real edge.
Totally. Seeing how macro trends like currency exchange rates can filter down and create micro opportunities.
Absolutely, and you can start to see why a weaker dollar might make some private equity firms really excited about the prospect of buying up American businesses.
For sure. It's like a green light.
So let's move on to the next stage. How do they actually structure these deals, especially those big leveraged buyouts we talked about?
Okay. So with LBOs, we're talking about borrowing a ton of money to buy a company.
Right, using debt to make the purchase.
Exactly. And it's important to understand that while our sources didn't explicitly connect a weak dollar to lower interest rates,
Which would make borrowing cheaper.
right, there's a bigger economic picture to consider.
So we can't say for sure that a weak dollar automatically means private equity firms get better loan terms.
Not directly, but the overall economy affects both the dollar and interest rates.
So a weak dollar might be happening at the same time that interest rates are generally lower,
Exactly, maybe because of a slower economy or something.
which could make those massive LBO loans a bit easier to swallow.
Makes sense, the pieces all fit together.
Right, so the cost of capital, how much it costs to get the money for the deal, is always a major factor.
Always a major factor for sure.
Private equity firms use all sorts of funding mechanisms,
Institutional investors, debt funds, all kinds of things.
and the appeal of those options can really change depending on what the economy is doing, including how strong or weak the dollar is.
It's a complex ecosystem.
And just to be clear, we're talking specifically about private equity deals here, not what happens in the public stock market.
Right, different rules, different games.
So even though a weaker dollar can make a target company look cheaper on paper,
Doesn't mean it's a slam dunk.
nope, that's where due diligence comes in, which is basically doing your homework before you buy.
Super important. Even if the price seems great because of exchange rates, you still got to make sure the business itself is solid.
You can't just rely on a favorable currency exchange to make a bad deal good.
Exactly. Due diligence is all about looking beyond the surface.
Digging into the company's finances, their market position, their management team, their growth potential, all of that.
Getting the full picture.
Currency fluctuations are just one piece of the puzzle.
Right, a weak dollar might get your attention.
But you need to understand the company's core operations, how resilient they are, how adaptable they are to change.
Can they handle the ups and downs?
Exactly. Can they grow and evolve? Can they handle a challenge? All of that is essential.
It's about making sure the business is fundamentally sound and can generate those returns you're looking for, regardless of what the dollar does.
Due diligence helps you separate the real opportunities from those that might look good on paper but have hidden problems.
It's like a safety net to protect you from making a costly mistake.
Okay, so let's say a private equity firm has done their due diligence.
They've checked all the boxes.
They've bought the company.
Now what?
Now the question is, how do they make it grow? How do they increase its value so they can eventually sell it for a profit?
And this is where that weak dollar can actually help them, especially if they're thinking about expanding internationally.
How?
Okay, think about it. A weaker dollar makes U.S. products cheaper for buyers in other countries whose currencies are stronger.
Because their money goes further when they're buying things priced in dollars.
Right, so if a company's exporting goods or services, a weak dollar can give them a huge competitive advantage.
So if a product costs $20 to make in the U.S.,
and the dollar weakens, let's say 10% compared to the euro.
that means a European buyer can now get that same product for 10% less in euros.
Exactly, it's like an instant discount, and that can lead to a big jump in sales for the U.S. company.
And more sales mean more revenue, which increases the value of the company.
And that's what the private equity firm wants.
It's a win-win. A weak dollar can actually help boost a U.S. company's growth by making them more competitive on the global stage.
It's one of those aha moments you were talking about.
Definitely, it shows how a factor that seems kind of abstract, like currency exchange rates, can have a really concrete impact on a company's success.
And then when it comes time to sell the company, that's when the strength of the dollar comes back into play.
Right. They've made the company more valuable. Now they need to find a buyer.
And the dollar's strength can affect how attractive that company looks to potential buyers, especially if those buyers are from other countries.
So let's say the dollar has gotten stronger since the private equity firm first bought the company.
Mm-hmm.
Now an international buyer using a weaker currency has to spend more to get those dollars.
So the company might seem less appealing.
Exactly. But if the dollar is still weak or has gotten even weaker,
then those international buyers are getting a good deal.
Their money goes further. They can buy more with it.
So they might be willing to pay more for the company.
That means the private equity firm can potentially sell it for a higher price and make a bigger profit.
It's all about timing and understanding how those currency fluctuations can impact the final outcome.
It adds a whole other layer of strategy to the exit process.
Absolutely. It's not just about finding the right buyer. It's about finding the right buyer at the right time when the currency market is working in your favor.
It's like a high-stakes game of chess.
With the dollar is one of the most important pieces on the board.
And just to reiterate, we've been talking specifically about private equity and those big institutional acquisitions.
Right.
This is different from investing in the public stock market.
Completely different ballgame.
Different rules, different strategies.
We're focused on the private side of things.
And one last thing to remember, currency values are influenced by a ton of complex economic factors.
Way too many to get into here.
We've been looking at the implications of a weak dollar for private equity deals.
Based on the research we did.
But we're not taking any sides on what causes currency fluctuations or whether a weak dollar is good or bad for the economy as a whole.
That's a whole other discussion.
Our goal is to stay focused on the mechanics of these deals and how currency dynamics play a role.
Sticking to the facts and the insights.
So to sum it all up, a weak U.S. dollar can create some really interesting opportunities for private equity firms.
For sure.
It can make American companies look more affordable.
Especially to international buyers.
It can boost growth by making those companies more competitive overseas.
Giving them an edge in global markets.
And it can have a big impact on how much profit those firms make when they eventually sell the companies.
It's all connected.
It's fascinating to see how a factor that seems kind of big picture, like the value of the dollar, can have such a direct effect on these specific private equity deals.
It really makes you wonder what other seemingly unrelated things might be influencing the investment world in ways we don't even realize.
That's a great point. There are so many moving parts to this whole system.
And so much to keep learning.
We've just scratched the surface today. The world of private equity and global currencies is vast and constantly changing.
It's a lifelong journey to understand it all.
We hope this deep dive has given you a good starting point for understanding how these things connect.
And maybe sparked some curiosity about what else is out there.
What other parts of the financial world are you interested in?
Let us know. We love exploring these topics, and we're always looking for new avenues to investigate.
Thanks for joining us.
Until next time.